Hey everybody, welcome back to the weekly market analysis for the week ending December 9th, 2022. We are in the last month. We are at the end, getting to the end of the last quarter. And next week is a really big week in the markets. We have a CPI release on Tuesday, and then an FOMC meeting, which is taking place Tuesday and Wednesday, with the press release released at 2 p.m. Eastern time on Wednesday next week, and then the press conference 30 minutes after. The markets are at a really, really important point, and there's a lot of potential for things to really get going in terms of price action to the upside, or depending on what happens, there is a great deal of room to head to the downside if things don't behave as many hope that they will. So our job here is to look at where price is and to manage our risk appropriately off of levels that we can clearly define, and then to look at data and to make sure that we're making informed decisions based on data, based on macro, along with our technical analysis. So let's jump right in here. And what I thought I would do is I'd start with just looking at the S&P 500, looking at the futures here. And I actually did this on the S&P and on the NASDAQ. You can see I have created this widening wedge, what a lot of people refer to as a megaphone pattern. It's a broadening wedge. I think that's the actual technical term for it. But usually these types of patterns are bearish. I mean, obviously any pattern is bearish if it breaks down from it, but I've found that broadening wedges tend to be more bearish. And a lot of people, they'll make broadening wedges for like really, really long time frames. They'll look at it like I saw somebody a long time ago making a broadening wedge pattern right here, from basically 2017 to 2020. People were talking about how that meant that price was going to have a big time crash and the S&P was going to go to 1700 or something like that. But I think that the broadening wedge pattern really only works on the daily time frame, on shorter time horizons, and that's what we have here. And a couple days ago I tweeted about this, and speaking of which, I'd like to just take a moment to remind you to hit the like button and to subscribe if you haven't. You can follow me on Twitter at Mr. J. Thomason. It's my personal Twitter account. You can subscribe to my free, absolutely free newsletter where I take much deeper dives on markets and also on data. You could subscribe to this channel, like I said, if you have not yet. But again, on my Twitter account, I posted on Wednesday that I thought we might get this, we might continue this sort of broadening wedge pattern. And it's lining up where my bias, full disclosure, is that I do think CPI is going to come in higher than expected on Tuesday, and then the FOMC is going to follow it up with more hawkish rhetoric, not about the amount of, or not about the rate hike being 50 basis points. I don't think that we're under any risk of getting 75 unless inflation was extremely bad to the upside. But I do think it will surprise a little to the upside, and that's going to reiterate the stance that the Fed has had for basically the entire year, and especially over the last few months, that they're going to be tighter for longer. And maybe they'll slow the pace of hikes. Maybe they'll do 50s and 25s until they get to wherever they feel is restrictive territory. But they're going to hold them for longer. And so I'll be interested next week in watching what the dot plot says about their expectations. Because for the last couple of months, you've seen Powell on multiple occasions say that they believed that their expectations for the terminal rate were actually going to be higher than in the September meeting. So if you think back to in September when we had the FOMC meeting, I think it was in late September, and we had the Fed come out and have their dot plot show that rates were going to be up to the high fours or maybe low fives. And so the expectation that they've been sharing thus far, and they've been telegraphing it very clearly, that they believe that the terminal rate is going to be actually higher. So I'll be looking forward to seeing that and how markets respond to that. We'll see if the market buys it. Right now, it doesn't look like the market buys. One, that the Fed will continue to increase rates up even higher than what is currently priced in, and the market doesn't believe that the Fed is going to keep them that high for very long. The market is actually pricing in rate cuts, like one or two full quarter point rate hikes next year by the end of 2023. So, but I think things are lining up on this wedge, as I was saying, that we actually, this balance, it's kind of not really a real balance because the futures contract rolled over on trading views. So right now it's showing that, we bounced, gapped up super high and then we sold down. So the S&P actually only closed at about break even. But in any case, point being that in reality, if you were to go to a metric like SPY, then actually SPY was down 0.75%. And so you have to take that into account. But what I suspected was that price is going to bounce a little bit, continuing this broadening wedge pattern, but that we were ultimately going to get rejected and that price is going to start waterfalling down. And I share this with, there are some guys on Wall Street that have been talking about crash risk in December. I actually share that viewpoint. Now, I don't have full disclosure. I mean, I'm not on Wall Street and I don't have access to a Bloomberg terminal. So I don't get all of the extensive data that a lot of these other guys can pull in. But just in terms of what I've seen from price action and where the Fed is at, and I'm as best as I can taking the Fed at their word. And maybe a lot of people are saying like, oh, we shouldn't believe the Fed. But like all the way back here, we've been saying, don't fight the Fed, don't fight the Fed. And now everybody's over here fighting the Fed and trying to say like, oh, well, the Fed can't do this or whatever. And you just got to, like, I'm just taking the position that the only thing that is certain is that the Fed is saying what they're saying, and I have to take that. And so I just think that things are lining up well for there to be another rejection here. So if we pull up our moving averages, we came up above the 200-day but got rejected at our descending trend line, which starts from the very top, the little wick at the top, the beginning of this year. And price got a clean rejection from there, came back below the 200-day moving average, closed briefly below the 100-day, but has since popped up above. And so price is kind of in this interesting no man's land between those two moving averages. But I do think that that this is going to get faded down and that we are going to come down. And I actually am looking, and I've posted this on Twitter, I'm looking for a period between right about here for price to, I'm not sure if I'm willing to say it's going to revisit like this wick low at about 3,500, but I do think we're going to see somewhere between 36 and 37 over the next 3 to 6 weeks, and more likely as soon as next week. And I think it'll be interesting as price reacts, and depending on what happens with inflation and the dot plot and what the Fed says. I don't want to diminish the possibility that price could go even lower, but that's kind of this kind of box is the area that I'm targeting within the time frame. And actually, maybe what I should do is I should do something like this. This is about the area and the time frame which I'm looking at on the S&P as kind of like a spot where going into the new year, the net liquidity dynamics are going to play out a little bit more favorable for markets overall. And this is, again, like Darius Dale and others have done a lot of work about how net liquidity is due to come off if you're going to, again, take the Treasury and the Fed at their word. And if inflation does misbehave and come in higher than expectation, you're going to see a big addition to the reverse repo facility, and that's going to take liquidity out of the market and bring and the S&P and other markets will follow that down. So I do want to be aware of that, but I'm not trying to get apocalyptically bearish because I just don't know. So there's that. That's kind of where we're at in the S&P. The NASDAQ has a similar pattern that's formed. We haven't even gotten up to the 200-day moving average yet. The last time we were at the 200-day moving average was on the March bounce. Haven't gotten really ultimately that close to it since. We are between the 150-day moving average inside that same sort of broadening wedge pattern. I think, like some others, I think that the NASDAQ is unwinding, like the tech bubble. It's another tech bubble. So I'm looking at an area something like this. It's a much wider area of space, but I could see us going back below 10,000 and maybe even going as low as testing 9,000 again before this is all over. So we'll see. And again, this time horizon is pretty short, like 3 weeks to 6 weeks is about what I'm looking at. No later than the end of January, but we'll see. Again, anything can happen. So I guess my point is that when you look at all these markets and look at the Dow clear above all of its moving averages, we got a cross of the 50 across the 100, and it's basically, unless price crashes substantially, multiple like percentage points like all next week, then this is going to cross. And so I think a lot of people will get excited about that cross, but I want to point out, I pointed this out on Twitter and people misunderstood what I was trying to say. A lot of people get really excited about what they call a golden cross. Actually, it's not on this chart. I can't look at that. Sorry about that. I got to do this in real time. It's DIA. So people will get really excited about that, but what they have to realize is that just because just because you get that kind of golden cross doesn't mean that a new bull market is starting. And if you actually go back and you look at the unwind of the tech bubble during the dot-com burst, this is not to say that this is what's happening on the Dow. I'm just trying to make the point. If you look at all the different times that so the criteria here is that price has to have crossed the 200-day built to the downside from the 50-day and then crossed back above. So I don't count in 99, but you actually see a cross come up again here in September of 2000. That was actually the top of a bounce. And then it happens again for just a brief moment, and that's after price is already cresting and rolling over, and then it has a little bit of a bounce and then comes down again. Happens again right near the peak of a bounce. And then it wasn't until, let's see, it happens again here. This is also the crest of a bounce where that takes place. And it's actually not until, I think, the fourth or fifth or sixth time that the 50 crosses the 200, that's the start of the new bull market. So I think that it's important to be aware that just because you get that kind of a technical cross, it doesn't mean that anything that price is just going to go back up. I think the red flag for me is that the Russell, and many of you guys, if you followed the channel, you know that I talked a lot about the Russell not confirming price action during all of 2021 was a problem. And here we have the Russell crossing down below its 50-day moving average. So that's bad news bears, closing below that level after being rejected multiple times after prairie dogging this 200-day moving average and prairie dogging the descending trend line, coming back below. That's a really bearish sign. And so we want to be aware of that. So on equity markets, what you want to be looking for if you're thinking about playing to the short side is you want to find a good place to manage your risk around. So you can use potentially the 200-day moving average. So a lot is going to depend on, we'll talk a little bit like how we did last week, going into next week, price action on Sunday night when futures open, and then into Monday morning. You want to see if price takes a bounce to the upside or not. If price goes and bounces to the upside, then the best thing that you could do, if you're thinking about taking trades, is to use either the 200-day moving average here on the S&P or the descending trend line as your guidepost. The safest thing to do would be, if you're taking downside trades, is to stop loss right above that descending trend line, and then a more aggressive stop loss would be right above the 200-day moving average. But again, let the price action on Sunday night and Monday dictate what you do. And then you're still, let's see, the same kind of analysis, that's just an example, but the same kind of analysis you would do on the NASDAQ and then on the Russell as well. See, like right here, you would have gotten stopped out on trades multiple times, but that's what you got to do. If you're going to be an active trader and you're setting your levels around, if you're setting your risk to reward around clear levels and managing risk properly, you have to take every trade. So, like for example, looking back, what could you have done here on the Russell? So if you were using either the 200-day or the descending trend line as your stop loss, and you took a trade, for example, then what would have happened is you would have gotten stopped out. And then the next time we came up to this level, right here, for example, on Friday the 22nd, if you were going to try to take a downside trade, then the most appropriate place to do it would actually be above the wick here, from that little peak above the trend line. And actually, if you had done that, then that's actually that trade is still active. And if you took that trade, say on Friday, November 25th, or going into trading on November 22nd, or I'm sorry, on November 28th, then that would have been a really good trade that you're still in, and you would actually be like around a 1-to-1 depending on where you took it on that candle. So I do want to call that out. Maybe something that you could do if you're ever not sure, because I know that maybe sometimes the struggle is that you're not sure, like you want to be really aggressive, because if you set your stop loss and your trade based on, or if your potential profit is based on that stop loss placement, then you obviously make more if you tighten that thing up. But the problem is that it's not very safe. So what you can do is, and I personally, when I enter trades, I enter multiple trades, multiple pieces of a trade, so that there's some profit taken, depending if my initial targets are met, and so that I can protect some of that gain and play with house money, and also just to account for multiple different places where I could get stopped out. So if I was going to risk like 0.5%, then what I would actually do on this in this situation is I would put the stop loss right above the wick and do 0.25% there, and then do another stop loss right here, and do 0.25%. And so and that way I have a cumulative 0.5% risk that I'm taking, but I'm accounting for, like, if this gets stopped out, which it would have, but with my trading rules, it would have gotten stopped out at break even. But then this trade would have been would still be on, and the trade would actually be pretty decently into profit. So that's an example of something that you can do. That's why you have to do TA, and that's why you have to manage your risk around levels. You don't just say, oh, I think price is going to go here, and I'm going to set my stop loss there. You have to be a lot more thoughtful and systematic, and have rules for what you're doing. But in all these cases, what you want to do is wait. If you're thinking about going long, then you're watching the downside trend lines. You're watching the descending trend lines, I should say, as your key indicator for to go long. And then the Dow, that's a really interesting place, because the Dow did make a higher high, and it's kind of flirting around that level. So it's a lot harder to think about a level to take. If you were trying to lay horizontal levels, it's like, okay, do you put it here, or do you put it here? Do you go here? Do you go here? Is it here? Is it here? Is it here? So my point is that when you have that kind of a situation where the level isn't clear, you have to use something a little more solid, a little bit less biased. And so you can use either one of the moving averages here, or better yet, you can make a trend line connecting the tops here, and then see if price comes down and retest this. And actually on the Dow, the best thing that you could do as far as risk to reward is if price does come down and hit this trend line at the same time that one of these moving averages is intersecting around that area, then that would be an excellent spot, because the support could be a lot stronger in that situation. So in this case, because the level isn't clear, and because there's no really super clear levels around where price is currently at, you just got to sit on your hands on the Dow. Even though, like, the temptation, and be aware of your of the dangers of, like, FOMO and stuff like that, either to the upside or the downside, because a lot of people look at this and say, oh, the Dow has come up so fast, so if it's going to sell off, then the best thing to do is enter a position now so I can make as much money to the downside as possible. But it's too risky. What if the CPI is lower than expectation? Price will just rip to the upside. So you got to be really careful, and that's why you have to be smart and systematic about that process. Excuse me. Take a look at the dollar and the yields really quick. I put this trend line here. I actually was watching something like this. I haven't even looked at this in a little bit, but I put this here because I was curious. I don't know why that's showing up like that. Let me try to make this a dotted line. Sorry about that. Trying to do this in real time. So I actually did that, but I wasn't sure if it was going to be, if that was legitimate or not. I have the same wedge on the 10-year, but look at, it's kind of interesting. Price has tried to come up and come up above, and it did wick above and did wick above, but continued to close down. And I don't believe that price has actually crossed and closed above, but it was fighting for it today at the end of the trading session. So this is what I'm watching. I think a lot of people are watching for price to continue to waterfall down, and it might, but because I think CPI is going to come in above expectation, that I'm actually expecting this to come up pretty hard. And I actually set this, I just today actually set this line that you can see, this horizontal line. Let me get rid of this right here. This horizontal line, I kind of put it there as a midpoint because the longer that the dollar stays down here, the less confidence I have that a bounce will get the dollar up to my level between 110 and 112. Like the top of that level would be up here at this yellow line, the big one. So this is kind of an area right here around 108, where if you follow along to this side, if you look at where I just drew that circle, that's kind of a general resistance area that I would be watching. So it just depends. I just want to be aware of that level right there. But I do think the dollar is going to bounce, and we are getting to a point where, you know, if the dollar broke down out of this kind of a wedge, and maybe the wedge is more like this. I don't know. Let's see. No, that doesn't work. But if the dollar broke down out of this, then it's going to touch the prime trend line. And if we broke down from that trend line, then that's, you know, if you're a dollar, I mean, you shouldn't be a dollar bull anymore by any stretch of the imagination if that were to happen. So yeah, we'll see what happens there. And then on the yields, we again have kind of this wedge pattern that I drew, and we are at the top at resistance here. So either this is going to break to the upside, and if it breaks to the upside, then I think it'll follow through and it'll move, you know, pretty significantly. And that depends also on, you know, what the FOMC does after the CPI release. And I just want to be aware, like I just want to call out to back here on August 1st, I made the call that yields, we were going to see another bounce and get to a new high on a new yearly high on the yield. And of course, everybody thought I was crazy, but here we are. So all of my goals as far as the yields targets have been met. So I've got no horse in that race for now. But I do want to be aware of the risk to the upside, because I think everybody thinks yields have topped. And I think that's what worries me, because even I'm at the point where I'm okay with yields topping. And I think that concerns me when everyone is convinced that this is the top. Then the Max Payne scenario is that it's not the top and price just takes off again. And it wouldn't be the first time, if you recall, the long consolidation from April 2021, which bottomed in August of 2021, and then didn't make a new high until January of 2022. So that's like 10 months of time that went by before the yields made a new high. And anything like that could happen. Even this bounce, it peaked in June and then got to its bottom in August. So almost 2 whole months of time. And it hasn't been a full 2 months since we hit this little peak. So be aware of the risk to the upside. So the inflation data on Tuesday and the FOMC response to that data on Wednesday is going to be really the key. If inflation is at or below expectation, then actually, in my opinion, I think it's got to come in below expectation. If it does come in below expectation, then I think that this is going to be the top in yields. I think that's the thing I'm uncertain about. If inflation doesn't behave, if the data comes in higher than expected, then I can't say with any certainty that this is the top. And I don't think anybody really can say with any certainty that this is the top. So if inflation is lower, like if that rate of change decrease in inflation does come in lower than expected, then this will definitely have been the top. And then everyone who told me that that was the top and everyone who said that the dollar topped there, then congratulations, they got that right. But you got to be aware. And speaking of data, I'm going to pull up my my table that I keep on the economic data. I've got a whole bunch of different growth data and inflation data on this sheet that I calculate. And here, what you actually see is if you look at the producer price index, don't pay any attention to the year-over-year numbers. Those are irrelevant now because all the base effects are going to be in if they're not already in. The PPI actually came in above expectations. So PPI was predicted to come in at 0.2 and 0.2 on the core, and it came in at 0.3 and 0.4. And so I already kind of personally, and I had the expectation that inflation was going to come in higher than estimates even before the PPI came out. But to me, this is just further evidence. So on a month-over-month annualized basis, we accelerated by 120 basis points. And on a 3-month annualized basis, we accelerated 160 basis points on the headline. And then on the core number, last month was a 0, and we were at a 0.4. So on a month-over-month annualized, we increased 480 basis points. While on a 3-month annualized basis, we broke even. And I think that's important because basically for 6 months, we've been declining in our 3-month annualized PPI rate of change, core PPI, I should say. And this is the first time in a, well, I don't know, this is the first time in a really long time, I don't even know how far back, that the 3-month annualized rate of change is the same on a month-over-month basis. And I think that that's concerning. So now if we go up to our CPI, what I have here is in the highlighted cell, I have what is the expected reading for CPI headline and core, and if it comes in above expectation, then we'll talk about that in a second. But just I want you to see the numbers as they are now. On a month-over-month annualized basis, that will have been a decline. So that's on the headline. It will be the same on the core CPI on month-over-month annualized if it comes in at the same level. And then on the 3-month annualized, it will have accelerated both on headline, but then decelerated on core. So that'll be interesting to see what the market reaction would be on that. And again, this is if it comes in at expectations. Now, what really gets concerning, and I'm going to focus most on the core metric because the core CPI is going to have more of the inclusive data like median CPI, trim mean CPI, and sticky CPI. It's going to be much more of a, it's going to have a much bigger connection to those items, which are more connected to core PCE, which we'll get, I think, in late December, early January. But what's going to happen here if we're even like 10 basis points above expectation, then on a month-over-month annualized basis, we will have accelerated pretty substantially, 120 basis points, and the 3-month annualized will be down. So still, that would be technically an improvement. But then, if you go any higher than that, 0.5, 0.6. 0.6 would be really bad. I don't imagine us getting a 0.6. I think it's more likely that we come in at 0.4 or 0.5. But even so, if that's the case, then inflation will have actually accelerated on a month-over-month basis. And so I think that that's something we need to be concerned about. If it did come in at 0.6 again, then that would be concerning because that would be 3 straight months of 3-month annualized CPI, core CPI at 6.0. That'd be really bad. I do want to call out that back in June to July, if you remember the July CPI data that got released in August, we went from 0.7 to 0.3, and then the next month we doubled. And so I actually expect to see a 0.5 on the month over month. That's just my guess, which still would have us coming in on a 3-month annualized basis. But I don't think that would bode well for the median CPI, trimmed mean CPI, and sticky CPI, which then which then of course has implications for core PCE to actually accelerate rather than decelerate. So I want to call that out. That's my prediction, but obviously you have to be prepared for every outcome. I think that again the PPI numbers coming in above expectation is ominous, and that's something we have to watch out for. You have to manage your risk around. If CPI comes in under expectation, all bets are off, and I think that it's time to be done being looking for short opportunities, and I think it's going to be long only for a little while. It's just my opinion, but we will see. So with that, thank you for watching. We're not going to look at Bitcoin or gold or crude or anything today, but you'll see some of that if you subscribe to my newsletter. So with that, I'll leave you here, and I hope you have a great weekend, and I'll see you next week.